have already studied the inventory lead time. Now the next session we have to take up before going for the assessing the economic order quantity, we have to see the inventory cost, how the total cost is there. There are various costs associated with the inventory control are often described under the following aids. Because we all told you to control the lead time, monitor the lead time, we can control the cost also. So now directly jump up the cost, we can have a certain type of cost which we can control it, and optimal use of the working capital should be there. So the total inventory cost, what is total inventory cost? If you suppose the ordering cost, the ordering, salaries and processing expense will be there, and if you have been purchasing the item, purchasing the item cost, transportation cost, your taxes, tariffs, freight and board, and all there. And next coming that, or the storage cost. What is the storage cost? That holding cost, receiving cost, storage cost, finance cost, insurance cost, security cost, warehouse cost, shrinkage cost, and last is coming the risk cost, stock out cost, shortage cost. These all the costs are coming from the inventory, total inventory cost. Now we turn by turn we have to explain that one. The setup cost. What is the setup cost? In a production line, if a item is manufactured, then to set up of the equipment before starting the production is termed as the setup cost, is independent of the quantity order for the production. Means it is not dependent on the quantity of item, but it is dependent on that before the production we have to set up the equipment. Suppose we have nowadays so many fast moving machines are there, the CNG items are there, the CNG parameter is set, and every parameter is set to see that the setup is there. So setup, how much time is required for the setup. So this time cost and these cost is coming on the setup cost. So how set up a machine before starting the production, it termed as setup cost, and is independent of the quantity order production. Means for the one item also it is there, for 100 item also will be there. Order cost. Order cost, this parameter, this order is set with the ordering raw material for production is shown as the order cost. Means we have to order the material before for the required for the production line is the order cost. The setup cost and order cost very much you see very precisely this thing, that setup cost and order cost are used with the same meaning in the inventory calculations. However, the difference lies with the inventory environment in which is used. The setup cost is used in the environment of manufacturing or producing of materials stored or consumed. When the order cost it comes for the material purchased or procured from the outside supplier. In other words, it can be described with the reference that make and buy strategy situation. Make is for the setup and the buy for the make. For the order is for the buy situations. The setup is for the make and order is for the buy situations. So this way you can know that what are the different costs, how different costs affect the inventory, we will see later on. But these are the cost segments, these are the element of cost coming in the inventory cost, which you see that way. They are the number of the items which cost elements in the cost for procuring of inventory or procurement of material from the store for the production line uses. So these costs are very much important. So these costs may be minimized by seeing the nature of cost and nature of use it is. Next points for the cost. These costs are often claimed in the following forms. These costs are often claimed in the following forms. With how this cost will be, in what way it is presented. The cost for placing an order means cost for placing an order means the advertisement for the cost, tender cost, advance or deposit cost, auction cost, cost of consumption of stationery and postage, telephone and communication charges, rent for the space used for the purchase department. The cost of infrastructure setting, trading expenditure, overheads. So see that these costs are often claimed in the following terms. These costs are taken to considerations while for activity. So these costs are naturally, the nature of the cost is mainly used for the cost for the placing an order. So these costs is having a detail element cost are taken into the inventory procurement. Now we come to the procurement cost. What is procurement cost? The cost of purchasing or producing a unit item is called procurement cost. The cost is most important when discounts are allowed. Cost is more important when discount is allowed. Means if you say any vendor is tell about that 100 items we will take, then I will take a discount of 5%. If you more than 100 items, we will give you a 10% discount. 200 items, we will get 20% discount. Means that way procurement cost will differ because discounts is taken into consideration. The same sense this for the setup cost and order cost is used for the two items under the procurement: production cost and purchase cost. Once for the setup cost is the production cost, and for the order cost is the purchase cost. The production cost in the term is for the make situations, and where the purchase cost is for the buy situations. It is very clear to you, make and buy, how which cost is set with the make situation, which cost is set for the buy situation. So the purchase cost and production cost, the cost incurred for the purchasing of item, it is a core price of the item called a purchase cost. Means it is a core price, mean the basic price of the item, not in GST and other taxes are involved in this way. Only basic price of the item is called purchase cost. Production cost, the cost incurred for producing or manufacturing or fabricating a product when the item is called in the house is production cost. Means when a cost incurred for producing and manufacturing means setup cost, your machine cost, operator cost, power consumption cost, material cost, these are all the overheads, these are all the coming on for the calculating for the production cost. So these items are added and this will come to the production cost this way. So you know about the purchase cost and production cost, how this will differ from that, what is the difference between the make and buy situations. So these all the what is the difference in the setup cost and order cost, what is the difference in the production cost and purchase cost, you all aware of that one. So we have a very much have to say that what is the inventory carrying cost. How much if you maintain a store full of inventory, what is the cost are associated with the store? What for carrying or handling the inventory, what cost involved? These costs associated with the storage are called carrying or holding costs. These are often found under the following components: rent of warehouse, store, storage space, and go down. Means these costs are coming in the carrying and holding cost. If you carry or hold a inventory in the store, then these costs are come into the picture. The first cost is the rent of the warehouse, store, storage space, and go down. Interest on the money looked up, means the money we have taken from the banks or everything, that what is the interest, because that money is come from working capital, that is not the huge money is taken from the own, that money may be taken on loan from the banks or any financial institutions. So their interest will be the money will be come in the picture, interest on the money locked up. Means what are the items in the stores, this money locked up items are there. So if suppose 100 crores of items are there, then 100 crores is blocked. So if their use is fast, then the money will be used. So insurance of stored equipment means what are the equipment in the store that will be under insurance. So their annual insurance cost will be there, their premium will be paid, so that if any case of the damage to the equipment by fire or something else, then the insurance will complete the items. Finance charges means what are the finance charges, means it is there that what are the money involved in that in every terms of the use of the inventory. The finance charges is there. Cost of obsolescence or dated material expiry means they are the dated materials that are not used, we have procured, but that is not in use, they are expired, they are obsolescence, they are outdated. So these material cost is also coming in this carrying cost, because these materials are not in use, but there are items where the cost involved in these materials which come to the carrying and holding cost. Cost of deterioration and evaporation, rejection and repair means what are the cost by physical means, by physical having deteriorated. Because sometimes we have to store, if iron we have to store, then it will be having a rust of that one. So this much deterioration will be there, or evaporation will be there, or rejection will be there, or repair of the material. If some faulty material is supplied, then it is repaired. So this cost is also involved that way. Cost due to completed the shell life, shrinkage, spoilage, because we have to maintain the batteries or something else, their shell life is there, they have to maintain after some time, they cannot be stored for the long period, 1 year and 2 years. The cost of depreciation of the material equipment means if the material of there and they are stored for the long time, 1 year and 2 years, then their depreciation will be there. So depreciation cost is coming also the carrying cost. Cost of production or fabrications means cost of production and fabrication means these are the costs involved in the production. Taxes and penalties. Taxes and penalty means government taxes and government penalty will be there for equipment not supplying the items on the right time to the vendor, to the customers. Salary and wages for security staff and stores management. These are all salary and wages for the security staff and stores management people, which is a non-clerical people, computers people and executives. Record keeping cost. Record keeping cost means you have to maintain nowadays very much maintain on the computers. There the hard disk or something is there. So all of a sudden when you identify items or placement of items, or you some item entering in the store, it must be recorded in the computer, and when it is going for the production line, again it will be the recorded in computer that it is sent for the production, this much of material is reduced. So nowadays the information system, what are the information system for the record keeping is coming cost in a slight big way. So these costs will be maintained, but very easy to record, very easy to identify the items, number of items available in the store, or there is no need of physical check. So these items are all the how much item have been going outside and how much item is balance item is there, you can came to know by record keeping. The cost of infrastructure and maintenance means we have to will be the housing the staff to infrastructure of the stores and maintenance of the whole overheads which are the extra cost which incurred in the not in coming in the way, because the petty cost will be there, that is taken as the overhead cost. So these cost, carrying cost and holding cost, which have a great impact on the inventory cost. So these are the costs which involve to maintain an inventory or to maintain a store or a storage place, either it is a warehouse or something shed is there, a store shed is there, it is maintained, and it is also stored in a very safe way, so that it should be cared from all the adverse actions. It can be safe. So these are the things which are the cost element of cost which is coming on the carrying or holding cost. Shortage or stock out cost is a very important thing. You should know about the shortage and stock out cost is a very important for the inventory and production total cost. The penalty cost for running out of stock when the item cannot be supplied on consumer demand. The cost include the loss of potential profit through the sale of items and loss of goodwill in terms of the permanent loss of customer as associated and lost profit in future sales. The stock shortage cost and stock cost, you come in a way that these costs, if suppose in a production line some item is missing, so the production line has to wait for that items. So the time which is waited, that is coming on the stock out items, then this cost will be there, that by what time it is this item is pending, the operation process is kept in pending, due to the want of this process. So the time cost of that one and the time of production cost scheduling is hampered. This much of coming on the way that in production way we have a shortage cost, stock out cost. Shortage cost means if you have a item, some 100 sales are there. Suppose in a winter season there is a huge sales are there where we have only having 10,000 items of sweater have been sold, and again need of the 12,000 due to the customer demand, and there is a shortage in the plant. Then again the plant has to manufacture this 1,000 or 2,000 point. They again hire the items, vendors, and the production process. And this production process, in addition, they are not a streamlined production process. This coming, the higher cost is involved that way, and these are the common shortage cost. These are the cost coming to the, suppose the 100 rupees for a item is coming on the previous item. Now it is coming to 120 or 130, and customer has to pay 130. So the 30 rupees coming as a stock out cost or a shortage cost will be there. So this is the permanent loss to the customer. The customer credibility is lost. The customer will understand that this manufacturer having not a right quantity of items at the right time. So this way we cannot go for this company. We can go for other company, which is, so this way the credit loss is there, loss of goodwill will be there, and sales of item will be there. So this is coming on the stock out cost or shortage cost is there. Shortage cost is linked with your production line, and stock out shortage cost is linked with your production, this goodwill of the permanent loss to the customer, and a stock out cost is linked with the production line. So it is very clear that stock out cost is linked with the production line, and shortage cost will be taken in loss of goodwill in terms of the permanent loss of the customer. It's associated the lost profit in future sales. Means I have told you that if the customer rely on the one company and that company is not giving the items in the supplying in the stores, supplying in the market sufficient quantity of items, then their goodwill will be lost, the cost of goodwill. So the customer will think about that this company is not giving the time adequate quantity of materials on time on different types of material. So we should not rely on this company. So there will be a loss of goodwill. So this is a permanent loss to the customer, loss of the customer, and it is ultimately the profit will be loss of profit to the company. Salvage cost or selling price. You understand shortage cost and stock out cost. Now coming to the salvage cost or selling price. When the demand of certain commodity is affected by a quality is stocked, decision problem based on the profit maximizing criterion includes the revenue from the selling. Means the salvage cost and selling cost, when the demand of certain commodity is affected by a quality is stocked, means the quality is not maintained. The decision problem based on the profit maximization criterion includes the revenue from the selling. Means it is based on the maximize the profit criterion includes the revenue from selling. The above two costs often confuse us. The basic difference is that shortage cost is incurred due to the stock out, shortage cost is due to the stock out, and the salvage cost is due to the excess stocking. Means shortage cost is incurred due to the stock out, and the salvage cost is due to the stocking, excess stocking. In a both way, the loss will be there. The shortage cost is also involved your profit is adversely affect the profit, and the same time a salvage cost is also affect the negative effect to the profit. So this way we can see the shortage cost, stock out cost, salvage cost, selling price. So now cost of system operation information system. As a stock level changes, someone must update the record when by hard the computer when the inventory level are not recorded daily. This operating cost is incurred in obtaining actual physical counts of the inventory. These operating costs are much more fixed than the variable over a wide quantity range. Means the cost of system operation and information processing. As a stock level changes, means someone must update the records whether by hands of the computer, because now a time that it is already operated by the computer. So the cost of system operation information processing is there. So how much item it is, only the items are taken in the store and issued for the use only by the computers. And by anything, even your medicine shop you go, they will see in the computer that how much this material is available in what Almira and or a place of their location, and how much available is there. So they can immediately dilute they immediately decrease the items which the item is sold. So that much computer updation or balance is maintained in the computer. So this way inventory level are recorded daily, but if it is not recorded daily, then operation is very much inaccurate, and you just having no knowledge that how much of item is available and where is the item available. So nowadays the custom of system operation information processing is having a very greater importance, and having taken into to easy the operation of the inventory in the store. Now coming to the algorithm, the most important algorithm of the inventory management, or concept of the economic order quantity. What is? Means how much to order or when to order. These two questions will be replied by the concept of the economic order quantity. As long as the inventory is not realized into the money, so like money, it is felt that materials are dead investment since they block the money at the way of the profit. This inventory managers will instructed to maintain just sufficient stock. It is well known that higher stock means higher block of money, working capital. Other side of the coin, under stocks means they interrupt the production, makes the machine and man idle, hence affect the reputation of the industry by not meeting the demand or not fulfilling the promises. Why this concept has come? So this is the answer of that one, why this concept has come. The operating doctrine of the inventory, that is when and how much to order of a stock, depends on how much it costs to the organization. When and how much order to a stocks depends on how much it costs to the organization. These lines are very important. The concept of the optimum order quantity, which is called economic order quantity, has gained prominent and significant role in inventory management. So the economic order quantity is also having decreasing the loss to the due to the inventory, and maximum use of the working capital, optimum use of working capital will be there. Again, coming to the concept of economic order quantity or optimum order quantity, as first proposed by Ford Wilson Harris in 1913. He made an attempt to draw a trade-off between the order cost and holding cost. What is the trade-off? It is the balancing of the two opposite sides. Trade-off means it is a balancing of two opposite sides. So the trade-off between the order cost and holding cost. We shall now understand the concept. First, let me think the order cost. Hyperbolic but not linear. Suppose you are going to purchase some notebook for which you have to need to spend ₹100 to order. This will almost same when you order 1 or 10 or 100, because the ordering cost is 100. When you buy 1, you need spend 100 rupees towards purchase cost. When you buy 10, you purchase cost per unit is 10. And when you buy 100 purchase cost, you spend on the ordering cost ₹1 per order. Thus, we can observe the unit order cost decrease and increasing quantity, but never becomes zero, that it varies. Means if you increase the quantity, the order cost will be the decreasing, but never be zero. Limitation of EOQ. Economic order quantity may not be ordering the exact quantity as per the calculations. Therefore, the ordering quantity will be generally nearest whole number placed in that. When a packet is fixed of the number of pieces, then seller decides that pricing says that instead of ordering 11 dozens, the order may be given for the 1 gross. Similarly, economic order quantity say that 108, if each pack is normally commodity of 26, then a buyer needs to purchase either 4 or 5 packs. Neither is in economic, but the 4 packs create a storage and 5 packs create the over inventory. The economic order quantity is the practical situation. The transportation will be modified. Modifying means in order to get the better freight rate may differ from the economic order quantity. Sometimes the saving in the freight may be more than the compensation of the extra holding cost. These are the limitations of EOQ. Simplification of routine, a time when difficult for the instance, then instead of 13 times in a year, and may order a once a month for 4 weeks 13 order, only gives the 12 orders. So these are the limitations of that one. You can see that these are the limitations that in the case of perishables, seasonal supply factors and liberal discount or concessions. These are the limitations for the economic order quantity. Then how the mathematical sampling or mathematical algorithm is developed that way. Then this is the first to define the term involved the mathematical expression notations. Actually, I am giving a slight calculation of this one. The more of the calculation or illustrations on your course material, you can see that way. But just for the understanding it, how the economic order quantity is calculated, I have taken that one. So C0 is the ordering cost per order, CC is the carrying cost per unit per year, D is the annual demand of equipment per year, P is the price of item, and Q is the ordered quantity per year. Means these are the parameters of the different types of this one. Then how that annual order cost, how to know the annual order cost AOC. First to define the total number of orders in the year, means the total demand of the year, the quantity ordered per order, means total demand is the D. Demand is taken in always for the year. So demand is D, and per order how much quantity will be there. Suppose having the 100 items are there and it will be the 10 quantity one order is there, then the total number of order will be 10. So the D by Q, total annual order cost. So the order cost per order C0 into D by Q means the number of orders. Annual carrying cost, inventory cost, carrying cost. Average quantity stock, that maximum quantity minus minimum quantity divided by 2. This is the average we have taken that way. It is Q by 2, and the annual carrying cost is equal to carrying cost per unit per period into average quantity order, means the C into Q by 2. You know that what is the annual carrying cost and annual ordering cost. So well we can understand the things in a much in a year, much in orders. So the annual purchase cost, the price of item into demand P and D. Annual total cost is the total variable cost and total fixed cost. And this annual total variable cost is a break in the two elements, that AOC, annual order cost, and annual carrying cost, plus APC, total fixed cost. You just having in equation all the things which have declared over the calculated in earlier page, and we will see that, and just to differentiate calculation, differentiate into in the terms of the order quantity that way. So we can have the quantity is 2C0 by D by C. It is coming in the quantity, the optimum quantity is coming out that way. And if we come with total cost in terms of the cost equipments C0 and C, this is the TVC, means total variable cost is equal to C0 into D by Q into C Q by 2, and the total variable cost, because the fixed cost is always fixed. So total variable cost again need to be putting on the data, and we'll got that what total variable cost will be the 2C0 ordering cost and carrying cost into demand. So the Q and this ordering this cost is incurred, that ordering such a level only variable cost is deferred, fixed cost is constant. So we'll get a minimum cost for that one, and this will decide the profit. We have already seen this way that we have discussed the economic order quantity, but in course material you have a wide range of calculations and mathematical sampling is there. You see that you can see the examples also, how the mathematical way we can solve the stored problem, and illustrations. So you fully have go through this illustration. This is a guidelines for the your studying and course material. So all the costs which involve that way, you should practically acknowledge them and practically have a good idea of that, then so that you can maintain your inventory or store where working, you can maintain inventory in a better way. So this is this way we can have a just economic order quantity, just a normative way, so that we can see how they affect the economic order quantity, what are the limitation of economic order quantity. You see that in each case you can use this algorithm, so that we can how much to order and when to order and how much to order, so that total cost, variable cost should be minimum. So we conclude here, where to minimize economic order quantity is taking that to total variable cost for the ordering cost, and this carrying cost should be minimum. So we conclude here. Thank you very much. Thanks to you.